here's the reality. I don't care who you talk to. When it comes to money and reaching some type of goal, there's only two things that you can do. Two. I don't care who it is, Dave Ramsey, whoever. Right? Whoever it is, right? I can make more money, or I can cut expenses. You pick one, or both.
People are stuck in the place that they're in largely because of the fact that they're not around people that challenge them. And it's not that they don't know those people don't challenge them, it's that they're scared to be alone.
I am going to make a personal commitment to execution over perfection.
Right now, my company is making, over $200,000 a month.
If you give me a piece of music, what am I going to play? And you put that same, piece of music or elements of music in the hands of Michael Jackson, what is that going to create? Little becomes much when you place it in the hands of the master.
All right, so welcome to another edition of Believers Breathe, the podcast, where the aim is to help people embrace self-awareness, self-confidence, and self-worth. Really interesting guest with me today. Been waiting on this for a long time because everybody wants to know about money. But, man, I got Marcus Johnson with me, and we've made this happen. I think this was supposed to happen once before. I'm not sure exactly what happened, but we are here, and I'm thankful for that. Let me make sure you good with this?
Yeah.
Cool.
Appreciate you for having me.
Yep. So, man, just tell the people a little bit about who you are. Obviously, I think that you're doing a whole lot around Nashville, so it may not be a lot of people in surrounding areas that don't know you, but tell us who you are.
Yeah, man, that's one of the hardest questions, man, to talk about yourself.
Yep, for sure.
But again, my name is Marcus Johnson. I am a financial planner here in the area. We specialize in retirement planning, so anything that has to do with, making sure that you have the right funds to be able to retire comfortably, and also helping people to basically just have an overall financial plan, right? So a lot of times people come to me and they say, hey, man, I just want my money to grow. Right, but we just need to be a little bit more specific in that, right? So what do you want your money to do for you, right? So what is an ideal plan for it? And so we kind of help you construct that together to make sure that we can move forward, whatever it is, right? So do we want the money to go for a house, a business, for retirement, right? And if in retirement, what are we doing in retirement? Are we traveling? Is that domestic, international, right? So, kind of just defining all those things, and we help people get that clear picture. Started my career on Wall Street. Back in 2010, 11. I spent, 4 or 5 years with various firms on Wall Street, and then that's when I decided that I wanted to kind of go into a more client-facing type of practice, and I've been doing it ever since.
That's dope. So we're obviously here to talk about money, but I do want to give the interesting way that I met you was through music.
Yeah.
So I worked at TSU for 6 years, and we had a Christmas party, and I remember you coming there, saxophone, creating the vibe in the room. So I thought that was an interesting kind of dynamic that you're into money, but you're also into music. Because normally I see if someone is into music and if they're into something else, it's normally under the arts as well. So maybe I do poetry, or maybe I play multiple instruments. Or if I'm into money, maybe I do finance and advising, but I also do taxes. But you got art and you got money. So
left and right brain.
Yeah. So how does that relationship work? Have you always been into both, or?
Yeah, man. So I'm from Nashville, so a unicorn in that sense, right? A lot of people starting to migrate here, but I went to National School of Arts for high school, and so that's kind of where I got that background in music, and it's always been something that's been near and dear to my heart. So never could let it go, right? And so I started kind of delving into the whole investment scene like my freshman year in college. And so, I just kind of got a liking to it. I started reading books like, Intelligent Investor, which is one of the main books I tell people to pick up by Benjamin Graham. Make sure you get the revised version. And so I just kind of started getting into that. And, you know, the music just kept following me, right? So I got an opportunity to play with some well-known artists, like, you know, from El Varner to John Legend.
Oh, so you playing for real?
Yeah. I put out an album in 2016 called Passion Speaks Louder. And it's just something that, you know, it's just in me, man. And you know, for a while, people was trying to put me in a box, right? So either people knew me for one or the other, and never was both. But it's so ironic that, you know, for somebody that's a regular guy, right, they want to put you in a box, but, you know, your celebrities can do multiple things, right? Jay-Z, y'all don't just think of him as a rapper, right? You think of him as a businessman. And I kind of, you know, the same way, right? So I can do multiple things. I don't have to just do this one thing. And for me, it's the love, you know. So I love music. I love jazz as my favorite genre. And, you know, it's just something that I can't give up.
That's dope. Interesting fact. So I'm writing my second book right now. Okay. And, bro, you pretty much have gotten me through this thing with that album.
Oh, man, appreciate that, bro. Appreciate that, bro.
I listen to it straight through, but when I get to Olivia and Sex in the Rain, I go on repeat.
All right, man, I appreciate it, man. It made me feel good, man. It lets me know that, you know, people actually listening to the album. And it's great to hear that, you know, that validation from other people. Just because, you know, you can listen to it and you can think it's good, and then if something like your closest people, of course, they
always gonna rock with you.
They're gonna rock with you because that's your people. But when you start to get outside of that, man, that just makes me feel good, man. I'm actually working on a new project now.
Can't wait.
So, you know, I'm hoping that it can be out, you know, this year. We'll see, right? I mean, I'm my biggest critic, right? So, you know, when I get in that space, like, it's just, because it took me a while to even get that first project out, right? I started working on that probably in 2013 and didn't come out till 2016. And so, you know, when I get into that space, man, I just want to make sure that it's right.
It's nice.
So,
that's dope, man. So you said that you started the investment deal in, you said your freshman year of college, was that right? So did you study finance?
Yeah, so I actually got a degree in economics and finance, concentration in finance. And so what happened was I met with a guy, his name is Antoine Finch. Never forget him. We don't really talk as much now, but he kind of introduced me to it. And so at the time, TSU has a program where they partnered with the TVA. And so the TVA at this time, I don't know if it's still there, but they gave us real money to invest. And so, you know, it was like $500,000 to invest, right? And this is at TSU. And so, you know, now, of course, they had guidelines on things that you could and couldn't do. And so me and him kind of got together and we started making trades and, you know, started to kind of dive into what this looks like and started, you know, kind of learning about this stuff. And then we did so well, we did like 38% in 1 year. And so I was able to leverage that experience to get an internship on Wall Street. And so from that internship, my sophomore year in college is what landed me the job when I graduated. So, you know, just that relationship with him, and man, that's a really sharp brother. I mean, he knew this stuff like backwards and forwards when, you know, we 18, 19 years old, and he's talking to me about derivatives and standard deviation, and I'm like, man, what are you talking about, right? And so, you know, kind of just getting that knowledge from him, and then, you know, just being able to leverage that, man, is really how I started my career.
That's dope. That's dope. So where did you do on Wall Street? Who was you working for?
So I worked for AXA, and AXA they own AllianceBernstein, so I'm sure people have heard of AllianceBernstein. And so what I was a lead associate. And so basically we was a liaison because we didn't manufacture products there. So we used third parties. And so my job was to make sure that people like me now understand how these products work. And so, you know, people think of finance, they just think about money, but there's actual products that people put together, right? So, you know, what stocks go into this portfolio or what ETFs or, you know, that type of stuff. And so
I'm talking spicy right now.
You know, my job was to make sure that people understood, or the advisors who were selling this to the masses, they understood what was in it, how it worked, et cetera, which works great now because now, you know, on the other side, I can talk to people about how this stuff works, you know.
All right, so this is the point where I want people to make sure that you're locked in. If you don't have something to write with, make sure you get something to write with because we're going to dive into some detail. We're going to educate today because I have a lot of questions.
Yeah.
I also know a lot of other people have questions that they want to get answered. And we're in the information age to where anybody can hop on Instagram and start talking about money.
Yeah, man.
With no real backing.
None.
No experience. And so I want you guys to be able to get it from somebody that's doing it, somebody that I've invested money with. And so, yes, get you something to write with. take some time to lock in. I think that we can get set free today in a lot of areas. And so using that experience on Wall Street, right? What made you transition into wanting to do your own thing? Because I feel like everybody looks at Wall Street as the end all be all. This is where I want to be. It's like I made it, I've arrived. But what prompted you to do your own thing?
Well, so for me, and you know, I'm only speaking from my experience. So if anybody's out here listening who actually walking on Wall Street, I'm not trying or want to get to that. You know, I'm hoping I'm not discouraging you, right? But just my own personal. I don't think that my corporate skills was where they needed to be. So maneuvering through that corporate structure, I wasn't in the right place. And I've always been the type of guy who I never wanted to, you know, have somebody telling me what to do. That was just always my mentality, right? And so when you get into that structure, you know, being one of color in a space and not really knowing how to maneuver, right? So you go to, you know, a black school all through, you know, elementary, middle, whatnot, and then you go to a black college. And then the first time you actually interacting with different races, and when you're living in New York, it's a melting pot. It's people from, you know, all over the place. So I think for me, that experience it helped me grow, but I don't know if I was necessarily ready for it. And so, you know, that kind of tainted me a little bit. But besides that, I always knew that I wanted to do more than just doing it for myself. Right. So what's the purpose of me, you know, learning all this, you know, knowledge and information and then not being able to give it to other people who look like me? Gotcha. So I just kind of use it as a time where, you know, I'm going to try to soak up as much as I can. I'm going to learn as much, you know, from people who I look up to. Right. I still have people who I communicate with, you know, monthly that still work there. Right. I made some great relationships. And I said I'm going to just take that and, you know, come out here and give it to the masses. But before I even got to, you know, doing my own thing, I actually worked at a spot called Edward Jones first. And shout out to Sean Johnson. Every time I get on a podcast, I always have to shout him out. It's because he was the one who really took me under his wing. He's right here in Nashville, black guy, great guy, you know, was really doing some great things for people. And he really took me in to kind of teach me how to do this thing. And so I think the first thing for me was learning about the business. Right, so I didn't really want to step out there, and I think a lot of times people step out there on this entrepreneurial route and really don't understand the business first, and so now you're trying to play catch up. So I wanted to really learn. Okay, I understand about stocks, bonds, mutual funds, all that stuff. Okay, that's cool, right? But what about the business behind it? Because when you see a financial advisor, you just automatically assume that they're fine, right? But there's a whole bit. It's still a business, even though you're talking about money. You still have to learn how to run a business. True. Right? And so my time at Edward Jones, it really taught me about the business behind, you know, pushing products and pushing, you know, financial literacy, et cetera, et cetera. So I spent about 3 years there. And from there is when I said, okay, I can do this by myself. Right? Because I felt like I was giving up too much money staying there for them to have an infrastructure when I could build it by myself.
Is there a lot of what happens on Wall Street that the average person wouldn't know? Like, are people there genuinely, like, cutting people down?
I mean, you just have to understand, man, there's winners and losers, right? And so anytime you're winning, somebody is on the opposite side losing. Right? And so, you know, when people say Wall Street, really what you're saying, you're working in the financial industry. And so there's different, you know, avenues that you can do in the Wall Street, you know, area, right? So you got traders, you got investment bankers, you got, you know, people like me was like more like back office, right? So I mean, there's so many different facets that you can do. But I want to say one of the biggest things that I think that people should know is that there's layers of different money that people are making, right? Most people come in as an analyst first, right? And then they're trying to get promoted to that associate level, and then from associate level they're trying to get to VP and so forth, right? And so the money that you can make, you know, in this career, if you go down that path, I mean, if you're an investment banker and you make it 5 years, you won't have to work anymore. That's facts.
Really?
I mean, because usually what happens is guys spend about 5 years, you know, because you're putting in crazy hours. I mean, people talk about billable hours for attorneys, and I know they're putting in work, but investment bankers are putting in work too. You know, you're talking 12, 13, 14-hour days, 5 days, 6 days a week. So you're putting in real hours, but in 5 years, they put in that time, and a lot of them start going to do other things because they made enough money.
So what exactly are they? Why are they putting in long hours?
So anytime a company, so let's break it down, right? So you got two markets. You got the primary and the secondary. Okay, most people are participating in what we call the secondary market, right? So if you have a Robinhood or a Stack or something of that nature, you're buying on the secondary market. Okay, but where the money is really being made is in this primary market. So an investment bank like Goldman Sachs, J.P. Morgan, Walter Blair, like those are companies where they're actually putting together what they call a pitch deck to put the stock to make it go public, right? So take Uber or I don't know, any company that before they go public, they call it an IPO, initial public offering. That investment bank is what's putting that IPO together. Right, so Facebook or Uber or whoever, they're going to find an investment bank to kind of put the deal together. They're going to get some shares in the primary market, and then they're just waiting for it to go public to go into the secondary market. And now they've really already made it because they're buying these shares at $10-15 a share. And then when it comes out, right, it might go to 50 in the first day that it goes public. Now
they've already won.
You've already made it. They've already made their money. Now, of course, they're going to still hold shares or whatnot, but they've already created their wealth in this, primary market. And, one of the things about it, to be in the primary market, you have to be what they call a qualified investor.
How do you qualify?
So you got to have a net worth of, I think it's $1.5 million, and have $250,000 of liquid money, right? And so one of the things I was just on the podcast talking about, one of the biggest issues that black business owners are having is we have a lack of liquidity, right? And so, we might have a great product, et cetera, but then when it comes down to things, we don't really have liquidity to get those loans, et cetera, to do, to kind of grow our business. But, so you have to have that. But really, that's just the entry level, right? Either you have a qualified investor or somebody who's a qualified investor who can kind of get you in a deal so that you can kind of make that money.
So when you speak about liquid, so if a company says this year we did $250,000 in revenue, speak to what you mean when you say liquid.
Yeah, so just because I did revenue, $250,000 in revenue, that doesn't necessarily mean profit. Right. So it's great. Anybody out here doing $250,000 in revenue, great. But what does that profit look like? And then with that profit, what are we doing with it? Right. So is it going out the door? Am I paying myself? Am I going out to buy that new Mercedes, 550? What are you doing with it, right? And so generally it boils down to, right, you might have a good cash flow and it's going, you making money, but we're not really keeping anything and then we're not investing it. And so, one of the biggest things that you can do to start building liquidity is start to have a retirement account, especially for business owners, right? So whether it's a SEP, whether it's a simple, whether it's an individual 401k, right? Because all that money is going to be considered what you can do liquid, and you can use that on your balance sheet to go get loans because it's liquid. You can meaning that I can get access to it, and so that's one of the areas that we're lacking in, or even cash in, life insurance, right? Where you're building cash inside of your life insurance policy, right? That's still liquid money because I can go and get to it, and I can use that as collateral to do other things.
I gotta get into that. All right, so look, you mentioned Robinhood. I have a Robinhood account, right?
Okay.
And I'm in a group with several guys, and we're making little small investments. Into the market, secondary market. What is your recommendation for how we deal with those type of apps like Robinhood, E-Trade?
So I promise you, and I always have to say this because I am an advisor. This is my opinion, right? Always seek your professional advisor before making any investment decisions, okay? So I had to put that in there. So you make sure you got a little line in there that says that. So I don't want nobody, Marcus said, right? So here's my thing, man, and this is no disrespect to anybody who uses those platforms, Robinhood, Stack, whatever, right? My issue is that most people are only buying a fraction of shares. Right, so you're buying a half a share here, half a share that, and so really where you're gonna see that real wealth and starting to build that up is that if you're buying full shares, right? Because think about it like this: 10% of 1,000 is what? 10% of 10,000 is what? 10% of 100,000 is what? 10% of 1,000,000 is what? You see what I'm saying? It's the same percentages, but the money looks a lot different. Right, and so where people get frustrated is that if you put up $1,000 and you get a 10% return, which is actually good, right? But it's only $1,000 that you have invested. So that 10% really, you're like, man, my money ain't doing anything. I ain't really making any money. But let's take a step back. So one of the basic principles that I talk to people about when it comes to money is understanding how money works. So there's a huge difference between knowing how money works and knowing how to make money. There's plenty of people out here who know how to make money, but they aren't doing the right things with the money once they get it. And so here's one of the basic principles. I say, if you don't understand this, or you're talking to somebody about money and they can't articulate this to you, you probably should stop having a conversation with them. And that's the rule of 72. And so what the rule of 72 says is that I take the number 72, I divide it by the interest that I'm getting from whatever investment I'm getting, and that's how many years it's going to take for my money to double. So let's put it in an example. So if I had $1,000, and let's say that I was putting all my money in a savings account that was paying me 1%. Now, in real life, no savings account is paying you 1%, but we're just going to use it for a simple math. So I take the number 72, I divide it by 1%. That means it's going to take 72 years for my money to double. 72 years. Now, on top of that, we got this thing called inflation. So inflation is our purchasing power. Every year we live life, prices around us get more expensive by 3% on average. So if prices are getting more expensive by 3% and I'm only receiving 1% of my money, I'm actually trailing at a negative, right? So like if you're working at a job and they give you a 3% raise every year, really you're just keeping up with the pace of inflation. On paper, it looks like you're making more money, but the prices around us are still increasing.
I'm still paying for more things around me.
Exactly. Exactly. And so, one of the main things that we talk about is we got to at least be getting 3% or better on all of the money that's not in our emergency savings. Right? And so how we do is we help people put together what I call a spending plan, right? Because spenders spend. So I hate that word budget. Because spenders spend.
Yeah.
I mean, think about it, right? And so one of the basic principles, what I like to do for people in that instance is I say, okay, send me the last three months of your bank statements. And everybody just looks at me like, what do you mean? Oh, yeah, send me the last 3. I want to see what you're really doing. Because the numbers aren't going to lie. You can tell me all day that you're doing X, Y, and Z. I can look on these statements to see these last 3 months where money is really going. And sometimes I find, oh, man, you got Apple Music, you got Tidal, you got Spotify. Like, why do you need 3 different, streaming services that stream the same music? Like, why do you have that, right? And then you're talking about you're struggling, right? So that's one of the areas. And then one of the things too inside that spending plan is, number one, we're tracking to figure out what's really going on. And then the other thing that people don't do is they pay themselves first. So you pay every other bill you got going on, right? So whether that's mortgage, rent, phone, Apple Music, whatever, you paying all that stuff, but we forget to pay ourselves. And so inside of my spending plans, I always make sure that you account for that as well. Because if you put that in your spending plan, now it doesn't feel as bad because it's already accounted for.
That's good. That's good. You don't like the word budget. People are going to hate that, boy. They're going to hate it. So in terms of looking at what people's spending habits are versus what their goals are financially, how often do you see that those two things don't match?
Always. It's always, right? And I'm never going to use any, of course, no names and stuff like that, but I do like to use real life situations. And it always just, I'm not going to say I laugh, but it kind of just tickles me just a little bit when I get somebody who comes into my office and their goals are here, but their expectation is here. And it's just like, or the reality is here, right? So, example, I had a young lady come into my office. Her goal was to buy a commercial building. Great, right? I love it. But the reality is my credit's messed up. My income is not where it needs to be, right? And, I have bad spending habits. Right, so you want this commercial property, right? So you're trying to put the cart before the horse, right? You're talking about getting a rental property, but you still live in an apartment, right? So the issue with that is not that these things are bad, right? I mean, I'm not saying it's bad, but we can do better. But your goal is here, but you're not living like this is what you want your goal to be. So you can't be out here turning up, going to Miami, spending money on all this elaborate stuff when you're saying that this is the goal that I'm trying to achieve. And so that's generally where the the problems arise. And so I'm not telling people that they can't enjoy life, because I definitely want you to. But here's the reality. I don't care who you talk to. When it comes to money and reaching some type of goal, there's only two things that you can do. Two. I don't care who it is, Dave Ramsey or whoever. Right? Whoever it is, right? I can make more money, or I can cut expenses. Pick one, or both. Right? Now, for me, I live my life I want to live the way I want to live. So I'm going to figure out how to get more money. And not only am I going to get more money, but I want to diversify the ways that I get money. Right? So if I only have one income, I'm too close to none. Right? So you ask me, why you still do music? Absolutely. I make money off music. It's another form of revenue, right? To make sure that my lifestyle, so that I can DoorDash Starbucks, right? So, it's not a matter of, thinking about it as one way or the other. We can, either figure out how to get more, which I tell everybody, let's get multiple incomes, or we can figure out a way how to cut expenses. It's really up to you.
So you said cut expenses or make more money.
Or both.
Or both. Which do you find is normally easier for people?
I see more people saying that I can do without, right? So they'll figure out a way how to cut expenses, right? So one of the things that, after looking through so many, people's bank accounts, the biggest area of improvement I can see is eating out.
Man, I'm so guilty.
And listen, eating out, if you can cut down on that, I promise you it'll put some more money in your pocket. And then, this is one of the most important things I'm gonna tell you today, is having some type of saving system that's outside of your saving system that you can just transfer from checking to savings. Because what happens is that, say I'm gonna get a savings account, right? And that I can just move money from my savings to my checking, because as soon as your checking account gets low,
I'm pulling.
You guess what you're doing? You're just transferring it from your savings back to your checking. So really, it's not a savings; it's just a double checking. You're just putting money over here until
I run low.
Until you run low, and then you just transfer it back. So that's not real savings, because you still have access to it. So I generally tell people, put some money away and put it away and stop it from being stolen from you, because you're stealing your own money.
And what about how do you suggest people create multiple streams of income?
So some of the easiest ways to create different forms of revenue or income is to figure out something that you like to do, right? So anything that you like to do can be monetized, right? So I'll use self or my household as a example, right? And at first I didn't get it. Like, my wife makes money from her blog, right? Now, this is not something that's going to happen overnight, but it's a situation where you can create revenue by just doing things that you automatically enjoy doing. I love music, so I perform places. I get paid to do that, right? My wife loves to write about things and post about stuff on social media, things that she was going to do already, right? She's making money from that. And so, just everybody has something that they love doing that they could, figure out how to put a price, right? How to put a price on it and package it up and sell it. Now, that doesn't mean that everybody's gonna buy, right? But, you can figure it out, right? So at this point in my career with music, I kind of name my own price. If I don't want to do something, I try to price it out. And so if you really want me to come, then you'll pay it.
Yeah.
Right? And so some people say, oh man, I can't believe you're doing it like that. Yeah. Well, that's where I'm at. Like, if you want me to come perform, this is what it costs. If you don't want it, I can sit at the house. You know what I'm saying? So, that's, but, it takes time to get to that place. And, I think for the generation below us, they just have to understand, like, this is not something that happens overnight. And the same thing goes with investing, right? I think Warren Buffett says it best. Nobody wants to grow rich slow, but why? Why? You know what I'm saying? We've kind of gotten out of this place where, or we look down on people who stay at one company for 25, 30 years, right? What's wrong with having a nice 401k and a pension, right? Because the reality is that most companies aren't even paying pensions. But if I can get into a situation where a company is going to give me a 401k that they're going to match, and I'm going to actually do the match, right? Because a lot of times people get in these 401ks and they're not really contributing. We can have a conversation about that. Like they should be, but contribute to that, take that pension, grow rich slow. What's wrong with that?
That's good.
Why do we have to have it now?
That's good. So I was financially speaking, introduced to you by Jay Renee.
Okay.
And I interviewed her on my podcast. She was, I believe, the second episode. So shout out to her.
Shout out to Jay Renee.
She's going bananas right now with, with what she's doing.
Yeah.
Right? And she mentioned you in the podcast to say, I got with a financial advisor who has me here, right? But everybody's not going crazy and going bananas with that level of income like Jay Renee.
Right.
So I want to, how can we create a plan for the average income levels of 40, 50,000? What is step one, step two that people need to do?
Yeah, so step one, I would say, so if you came to me and you just sat down and you make 40, 50 grand, I'm going to take you through the same gamut that if somebody's making 200 and 300 grand, right? So I kind of treat everybody equally, right? Because you may not be making that money today, but what does tomorrow look like? And so I treat everybody that way, so I want to definitely say that. But the first thing I do, I have you fill out what I call a financial checkup sheet. I need to figure out where you are. And so, you know, having a conversation with people, they just tell you stuff. I need it on paper. Let's really look at what that really looks like. And so that gives me a better idea about, you know, what your situation looks like specifically. Because I don't want to just give you general advice. I want to give you something that's tailored to you, right? And so from there, I'll say, okay, this is what you look like. Now let's look at doing a spending plan for you, because that's going to be the next thing. That spending plan is going to be essential, right? And so what I'm trying to figure out is that how much income do you have coming in, and what do your expenses look like, right? And is there a surplus or is there a deficit? And so, you know, what that means in layman's terms is do you have money left over at the end of the month, or is your account being overdrawn, right? And so because it's really not about how much you make, it's about what you do with the money that you have and how much you keep and invest, right? And so, you know, either one. And so say, for instance, that you make $40,000 a year, let's just put that in those terms. And every 2 weeks or every month after you pay the bills, you got $500 left after you ate, entertainment, et cetera, et cetera. So one of the main things I tell people is that we never want to put 100% of our money into one vehicle. We want to make sure that we're diversifying across everything, right? So whether that's real estate, stocks, whether that's, retirement, et cetera, et cetera. That's just my philosophy. And so what we would do is we figure out, okay, out of this $500, realistically, how much are you comfortable with parting with every month? And I'll let you tell me, right? And so, sometimes I want to put the whole thing. We're not doing that. So I'll just go ahead and tell you we're not going to put that, because realistically, you're probably, it's not going to work for you. I just, after seeing this so much, I know. So in my head, I'm already saying $200 is where you need to be. So we could take $200 and we'll figure out a way how to invest that money for you going forward monthly, and we just grow it slow. And so we get comfortable with doing $200 monthly. And the reason why I like people doing it monthly versus lump sums is because it creates a habit for you. Because now you're automating your savings on a monthly basis. So you're creating that habit of, I know I need to put money up. I know I need to put money up every month. And it's like clockwork, right? And so once you start to form those habits, now we can start opening you up into more things. And so, one thing about it is that, we can grow rich slow with compound interest. It's the main thing, right? And so basically, let's take AT&T, for instance. If we buy AT&T, I don't know, I think maybe it's around $35 a share right now. And let's say we took $10,000 and we bought AT&T. AT&T pays a dividend. So if we back up, how do we make money out of stocks? Capital appreciation and dividends, right? So what does capital appreciation mean? It means I bought it at one price, it goes to another, and I sell it. I just made a capital gain. They call it capital appreciation. The other way is called a dividend, right? And so what a dividend is, a cash payment to that investor for investing into that company. So, they basically giving you an incentive for investing into their company. Now, all companies don't pay dividends, but AT&T does. And so let's say AT&T is paying you a 6% dividend. So if I took $10,000, invested into AT&T, right? Not only am I going to get the capital appreciation, but they're paying me 6% every year just for investing into AT&T. So that's $600 a year that I'm just getting from investing into AT&T. Now, we talked about compound interest, bringing it back together. I take that $600, I reinvest it back into my portfolio. So then the next year, instead of getting 6% of $10,000, now I'm getting 6% of $10,600. Compound interest. So every year, it's compounded, and that's how people get rich. So I've been seeing a lot of these narratives out here where people say, yeah, I'm getting these dividends and I'm taking them and I'm living off of it. Well, you're defeating the purpose if we're trying to create wealth. Now, if we're at a stage where, I'm trying to have an income stream, right, which I tell people that's when we get closer to, retirement, now that makes sense because we're not trying to build wealth anymore. We're trying to preserve it, right? We're trying to get an income, right? That's a different strategy. And so, I hate seeing that for young people saying, I'm going to live off my dividends. Like, no, we need to be creating wealth unless you already got the money, and then we can have a whole different strategy, right? But for people who are trying to get to that point, we definitely need to look at it in that light.
And so you said do you suggest taking something like $10,000 and putting it into one company?
Not if that's all you have.
Okay.
Right? And so I tell people that, I tell my friend this all the time. I say you never want to play with house money. And so what I mean by that, never take any risk with your money that this is the only money you have. So, I don't care what it is, right? Real estate, stock market, business. Like, I know we heard all these stories about how people started this business, they ran up the credit card, you know what I'm saying? That's cool, right? It makes for a great story. But the reality is, for every person who had that great story, there's somebody else who it didn't work out that way. And it's probably more of those people than it is of those people who actually made it work. So if $10,000 is all the money I saved up, there's no way as a professional that I would tell you to let's buy one stock. Even though AT&T is really what we call a blue chip, meaning that, it's one of the non-risky stocks that we could buy, I still wouldn't say, yeah, let's go ahead and buy AT&T with just your $10,000. We would probably need to spread it out, right? We could do mutual funds. We probably do a full portfolio versus it just being one stock. Now, if you had 100,000, yeah, we can do that. We can do that. That's no problem. No problem.
All right, so you get into the spending plan. You figure out what's going out, what's coming in. Do you have a surplus or do you have a deficit? Then you're going to find out, all right, this is how much you have left, and then this is where that money is going to go.
Absolutely. Absolutely. And it's not a one-size-fit-all, so it depends on your situation, right? So some people I might say, hey, man, this might be the best solution for you. This one may be the best solution for you, right? And so it just depends on where you're at. And so everybody's situation is going to look different.
Do you allow your clients to tell you how aggressive they want to be?
Absolutely, right? And so in part of, getting through there and doing like what we call a risk tolerance, we'll have that conversation and talk about, how much risk do you really want to take? And so, aside from that, I always ask this question. I don't know if you remember me asking you, but I think it always goes something similar to how much money do you not want subject to real estate, stock market, and inflation risk, right? And so I might word it differently, but I'm pretty much asking you that same question, like how much money do you want not risk to the fluctuations of the market? Because the reality is that right now it's volatile, right? So what do I mean by volatile? The markets are up and down, up and down, up and down. And, as a young person, you can kind of sustain that, but, once you start getting older, you're not going to be able to sustain that, because the worst thing that you would want to happen is you get 65 or 64 and you're ready to retire, and then the markets go down 50%. Right? And so, as we get older, our risk needs to change because we can't really take that hit. And, studies show that if you retire at 65 and the next year your portfolio gets hit with a 50% loss, the chances of you recovering for that and being able to live off this money is way, way less than what it would have been had you, kind of had your portfolio laid out differently. So, because most people think that if I lose 50% of my portfolio, that means I got to get 50% back to be even. That's wrong. Got to get 100%. Right? To get back to where I was. And so, the reality is that how long is that going to take?
Right. It's 65.
And the one of the biggest issues with that too is that not only am I took a hit, but I'm also taking money out as well. Because I'm living off this money, right? So I'm taking a draw off this money. So my portfolio is down, and I'm also taking money out as well. It's not a good combination. And so, as people get closer, we start having more conversations about, okay, let's make sure we got some of this money not subject to real estate, stock market, inflation risk, all that stuff.
Golly. So, you got that money that's going out into mutual funds.
It could be, yep.
And then you have REITs.
You got REITs.
Can you talk to us about what a mutual fund is,
Yep.
what a REIT is, and then what is the whole thing about ETFs? What is happening? What is taking place?
Okay. Yeah. So I mean, let's unpack a lot of that, right?
Yeah.
So basically, what a mutual fund is basically a pool of different stocks pulled together with a professional manager. So the idea is that instead of it investing into just one stock, now I'm investing into a pool of stocks. So I'm diversifying, and I have a guy who's managing this for me, right? And so companies would be like Vanguard or American. Or Fidelity, mutual fund companies, right? And so people get less risk associated with it when they're investing into mutual funds. Now, of course, when you have less risk, it's going to grow slower.
Yep.
Right. Now with REITs, it's kind of similar to a mutual fund.
Question first about mutual funds. So with mutual fund, that money, what companies is that money going into?
So it just depends. Every mutual fund is going to have different strategies, right? So you can have a growth mutual fund, you can have a income-based mutual fund, and so generally what happens is that mutual fund that you're investing into, they're going to have a range of different companies. We talk about hundreds of different companies that they're probably investing in.
Do those companies change?
Yeah, they can. They have some that are what they call actively managed, right? So that means that that manager is actively seeing, okay, this stock isn't performing the way we want it to, so we're going to pull them out and we're going to replace it with this one. But that's not something that you have to worry about. That's the job of that portfolio manager. His job is to monitor this to make sure that we're doing what it wants it to do, right? So BlackRock is a good example, right? So BlackRock is a huge company. They manage trillions of dollars, right? So I love BlackRock. I have a lot of clients in a lot of BlackRock funds because they perform well. And so that's mutual funds. That's how they work. Period. Right? You got a pool for it. You buy the mutual fund, the growth, whatever it is, income, global, and that's why I tell people, when it comes to investors, we want to make sure that we're not just investing in the United States. We want to actually have global exposure too, right? So we want to have mutual funds that are invested in the different countries as well. So we don't want to just be local, right? And so it's definitely a good option for people to kind of get started out. Now, the reason why people don't like them as much is because of the fees that are associated with them, and they do have fees. But I tell people that like this, man. No matter what it is you do, there's going to be a fee involved. It's always funny to me when it comes to fees on different things in the financial world. Everybody has questions, but when we go to the mechanic or whatever else, or when we got to go to the mechanic, when we go to Apple and buy an iPad, nobody's asking how much this costs to really make this iPad. You just pay what it is.
True.
All right, so I don't understand where the logic is on. I'm questioning this about money that's gonna make you money, but this iPad that's really it's not an asset really. It's really a liability. I mean, you probably need it, but it's costing you money.
True.
We
ain't asking no questions.
Tim, how much did it cost you to make it? You know what I'm saying? And let's go ask Tim Cook how much it cost him to produce this, right? Or anything, or the cereal, or but yeah, I think mutual funds are definitely a viable option. But now more people are moving what they call managed money. And so instead of buying mutual funds individually, what's happening is advisors like myself are putting together portfolios where you can get mutual fund, ETFs, REITs, all that stuff all wrapped up into one fee. And so it's working better for people because instead of every transaction you have to pay for something, it's all packaged up together and you pay it annually. That's kind of where the industry is moving. I'm not really seeing people come to me to just get mutual funds by themselves as much as it was 5-6 years ago. But it's still a good viable option.
And is that the easiest way to get your hands on stock like Facebook?
Yeah,
Apple?
I mean, yeah, because you can buy, a technology mutual fund. Same, you can buy socially conscious mutual funds, meaning that you don't want companies that do certain things that don't align with your morals. Right? And so there's some of those out there as well. right? And so, just having an advisor to kind of talk that stuff through can kind of help you figure out what mutual funds that you want to invest in. 9 times out of 10, people really don't care. They just want their money to grow, right? And so as long as you're putting them in reputable companies, a BlackRock, Fidelity, et cetera, they really don't care. But, sometimes you get people who come sit in the office and hey, man, like, I think we should do, X, Y, and Z. It just depends, man.
Gotcha. And then what about REITs?
So REITs are, it works just almost like a mutual fund as well, but instead of it being stocks, now you're talking about real estate. And so now, instead of investing into one real estate property, now you got a slew of different real estate that you're going to be, invested in. They can work good, right? But again, I tell people that I like going the REIT option if capital is an issue for you, right? Because now it's still liquid, meaning that I can get access to it. Because if I invest into a REIT, I can get my money back in 3 days. But if I invest into, say, this building that we're in right now, only way I'm getting money is if I sell the property. That doesn't necessarily mean it's going to happen today, tomorrow, 30 days from now, right? It's not liquid because I can't sell a portion of this building. I have to sell the whole thing. Versus with a REIT, I can sell a portion of it and still have some money that's invested into it.
Is that going into properties like hotels?
I mean, they have different ones, right? So when I was working on Wall Street, I can't remember the name of the company, and I probably wouldn't tell you even if I did, because I wouldn't be liable. But there was a REIT that was their whole thing was amusement parks. So you could invest into this REIT, and they owned all of the properties at the amusement parks, from like Kings Island to, Kentucky King. I can't remember all of the ones that was in there, but that they're doing some cool stuff inside of these REITs. And so yeah, I mean, you can find different ones out there that could be suitable for you. And that's the main thing. I tell people there's not really a such thing as a bad product. It's just, is it suitable for your situation? And so some products get bad names just because of people like to bash certain products. But again, they're not bad. It's just, is it suitable for you? And that's just, having a real conversation with your advisor, trying to figure out like, okay, this is what my goal is, right? Having a clear idea of what I want my money to do, right? And then specifically, is this gonna align to whatever that goal is? Is this product gonna help me get to whatever? And so, if you're looking at everything from that standpoint, you should be fine.
And then what about ETF?
And so basically ETFs is it's an index that tracks another index, or an exchange that tracks another index. And so like a lot of times people just do like a S&P 500 ETF, right? So it's tracking that. And so instead of it being actively managed, it's not actively managed. It's just going to do whatever that index does. And so that way the price is lower because you don't have anyone actively doing this for you. Right? So it's just tracking whatever the S&P. So if we bought a S&P 500 ETF, if the S&P went up 8%, that's what the ETF is going to do. Right? But there's not going to be any rebalancing or changing anything out because it's just going to track whatever that whatever that index does.
And do you have to have a certain amount to purchase that?
So I mean, it just depends on where you're getting it from.
Okay.
Right. So if you're in Robinhood or Stash, yes, probably not. Right. But if you're with some of the platforms that I like you to be in, like a TD Ameritrade or E-Trade or a Merrill Edge, that you can't buy fractions, you got to buy full. So if I'm gonna buy a share, it's got to be at least one share. I can't just go out here and buy half.
A fourth of a share.
I honestly like to see people buy 100 shares or more, right? Because now you have a real position, and then but sometimes that just means that maybe I shouldn't have Apple because Apple is $300 a share, right? Maybe I need to figure out some of these companies that have like AT&T or I tell people to invest in things that they use on a daily basis, right? So don't overcomplicate it, right? So for women, you use these female products every month. Why not own Unilever? That's the company who owns all that stuff, Dove, all that stuff, right? They ain't going nowhere, right? And so companies like that. If you a big sneakerhead, own some Nike stock, right? They own Jordan, right? So just things. Procter & Gamble, companies that we're using every day, they aren't going anywhere. Let's invest in those companies. Let's make money off of them because they've been making money off of us for years.
For years.
Yeah.
And so taking that mindset of actually getting some ownership into the companies that we use, I'm interested in this whole crypto phenomenon, because that's a lot, for me, it's a lot different than being able to like eyeball Nike or eyeball Apple, know about the history of the company, being able to research that, using those products. Do you advise people to get involved in crypto?
So, you know, you know,
either way it goes, they gonna get you either way.
Yeah, I know. I mean, you know, people gonna have an opinion regardless. So, here's my thing. I'm not telling people not to, but I'm just telling people to be cautious. And the reason that I say that is because nobody's talking about regulation yet. And so when the government gets involved, I think some things are gonna change. Now, what I will say is I've been seeing a big push from institutional monies to start going into crypto, right? So I've seen Barclays invest money. I've seen Morgan Stanley said that they was going to get into some. And, you know, once you start getting institutional money behind, you know, crypto or any asset, right, there's going to be some validity to it. I would say that, again, you know, if all I have is 10 grand, I'm not putting my 10 grand in crypto, right? So, but that goes back to my philosophy in the beginning is we want to make sure that we're diversifying, you know, our investments and our income streams, right? So I'm not going to put all of my assets into one vehicle. Honestly and personally, I haven't invested in crypto. I mean, I've been seeing it since, you know, 2014, 2015. Now, I'm stupid because I didn't do it, right? Because I could have made that way, but it doesn't fit with my philosophy on how I invest money. And so it has to be a good fit. And so, but again, if you're going to do it smart. Don't put all your assets in one egg, right? I think that it is going to come down. I don't believe that it's going to just continue to, because I mean, just think about it, man. We're not going to the ATMs yet, and you know, being able to pay for stuff with crypto just yet. You know what I'm saying? So, how long is that going to take? Is that going to be realistic? And the other thing about it is that I know sometimes I see people post it, you know, they didn't like, Blockbuster didn't like Netflix, and, you know, hotels don't like Airbnb. And, you know, you've seen those posts.
Yep.
But the one thing that I will say is, do you really think this government is going to let the dollar die? Just let that sink. Right? I don't know if I see that happening. Right? I mean, think about how much we really have going on with the dollar and everything in this country around the dollar. Do you really think that it's gonna go away? Listen, I could be wrong. I've been wrong before, but that's why I just tell people to just be cautious and you're investing in crypto. You know, you can have a percentage of it in your portfolio, and you might do well. But I wouldn't have majority of my money invested in crypto. I think probably the real play in that will probably be the blockchain. I think that's where the real play is, and not necessarily the crypto itself.
What is the blockchain?
So the behind the scenes, like how the stuff is moving, the technology behind Bitcoin and Litecoin and, you know, all that type of stuff, which probably that is some validity there. So, you know, I would probably start doing some research as far as on that stem. But again, I do feel like the people who made their money in crypto, they've already made their money. And so people are kind of late to the party, which, I mean, if I was to invest now, I'm super late. Yeah. You know, and I think there's other ways. But again, it goes back to nobody wants to grow rich slow. Yeah. You know what I'm saying? And so everybody's looking for the microwave of money. You know what I'm saying? Where can I put my money where it can just magically quadruple?
6 months, I need to be rich.
6 months, I need my money to double in 6 months. Like, let's be realistic in this thing, right? And there are some stuff that happened. Like, well, if you was in GameStop, just, you know, you could have made.
What happened with that?
I mean, so when it comes to how the markets work, right? It's what drives the stock price is demand. So if there's the demand around a specific stock, it's going to push the stock price. And so they had an app called Reddit, where a whole bunch of people just got on there and said, hey, man, we're going to go in here and buy GameStop. And if you have enough people going up and buying GameStop, it's going to push the stock price up. The issue is that you have to continue doing that, right? You have to be able to sustain it. And so the reality is that it's not going to be able to sustain at this price. And so what's going to happen is it's going to start coming back down, right? And so I'm just waiting for that.
So the people that started that probably won big, though.
Oh, absolutely. And, I don't know for sure, but I know for a fact that, that's not, I don't know if that's necessarily legal what they did. Because it's kind of like price manipulation in a sense. And so I don't know if there's going to be any ramifications on the people who actually started it. Probably not everybody involved, of course, right? But they're going to get a hold of that. Because Wall Street is not going to let you beat them continuously. let's it's not gonna happen, man. Like,
what is you said earlier? There's a such thing as a certified investor. Is that what you said?
I said sophisticated. That's not the word I use.
So you got to have at least one
accredited
investor. So the people that made those purchases into GameStop,
they didn't necessarily have to be.
They didn't have to be accredited.
It's just people on the internet.
They got a little bit of bread.
Main Street beat Wall Street. Because a lot of people on Wall Street lost a lot of money that day, and they're not gonna have that. It's not gonna continue to happen.
What type of money are you talking in order to be able to move a stock like GameStop moved?
You're talking millions, man. But of course, if you collectively
enough people,
right? So if you took everybody and we all said we're gonna put up $1,000, and everybody just said, I don't know, maybe I don't even want to put this idea out here, but especially not on here, right? So, but let's just say that everybody said we want to save this company, and we gonna put everybody just
put up 1,000,
or whatever you got. We just gonna all buy this stock. It's gonna go up. But the problem is it's not gonna be sustainable because you got to continue to keep putting money in there.
So does that happen often?
No,
when people...
I've never seen this happen before. Like not on this scale. That's what I'm saying. But technology is different, right? Things are moving. I've never really seen this happen in this instance, but that doesn't mean that it hasn't happened before. But I probably doubt, especially not on this platform, right? You got kids on here talking. I'm not gonna call them kids. I don't know. Like, whoever started it, I mean, they got some plug for sure. They got some pull.
Golly,
they made a lot of money. Whoever who was participating, especially if you just own the stock and you just sitting there and it was at I don't know what it was at, maybe $20 a share, and then it went up to 200 and something.
You eating good.
Amazing.
And the people that bought at 200 thinking it's gonna keep going, they're about to lose.
They're gonna lose. That's a fact. You can take that to the bank. You can take that to the bank. I don't know when, right? Because if I did, I promise you I wouldn't be sitting here. But it's gonna happen. And just for people to get better knowledge about this stuff, it's a website that I would tell you to always fact check your stuff, and it's Investopedia. Investopedia. It's credible, right? It kind of gives you a rundown of how stuff works, the ins and outs of whatever you want to look up. So if you want to get more information about ETFs or mutual funds or Reits or whatever you're looking towards, self-directed IRAs, that's kind of big right now. You can go there and you can kind of get into that stuff.
So let's talk about the end of the road before we get out of here.
Okay.
Everybody wants to solidify retirement.
Yep.
And it seems to be several vehicles to do that.
Yep.
You got 401k.
Yep.
Is what I feel like the majority of people hear about.
Most people have it. That work for a company. W2. Yeah.
Now, I feel like they're starting to grow this. They're growing the phenomenon of IRAs, and then within that, I'm assuming is the Roth IRA.
Okay, so yeah, let's break that down. And this is for everybody to know. This is where I'm an expert at, right? So I can speak to pretty much everything, but this is kind of my area of expertise is when we start talking about retirement. And so you got 401k, which is what we call a qualified plan, right? And so it's pre-tax account. So meaning that you put money in, right? And then when the money comes out, you have to pay taxes later. So they call it a pre-tax account, okay? That's directly parallel to what we call a traditional IRA. So generally what happens when you get ready to retire, you roll your money into a traditional IRA. Pre-tax money comes from one account, goes into the other, into the traditional IRA, right? Now they have some things now where they have what they call after-tax 401ks, or they have Roths inside of it. And so if you have a Roth, that's basically saying that's an after-tax account, meaning you've already paid taxes on this money, so when the money comes out, it comes out tax-free, right? And so a lot of people want to invest into Roths because that money is going to come out tax-free. Now, of course, there's stipulations and things that are, involved with it, right? I'm not going to get into those details, but That's generally how it works. And so as far as what people should understand is that, you know, when a 401k was first put into place, it was actually a 3-part system. So you had 401k, you had pension, and you had Social Security. And so those 3 buckets are what I was supposed to be pulling money for to be able to retire comfortably. But what happened over time is companies stopped paying pensions. So now I only have 2 buckets to pull money from. But what's happening with Social Security? Well, they keep pushing the age back, right? So first it was 65, now it's 67. By the time me and you get there, it might be 70, 72. And so what's happening is you have more baby boomers pulling out of Social Security than we, Gen X and, you know, millennials are putting into it. And so that's going to be an issue. And then the other issue is that if I ask you right now, what is the max amount of money that you can put in your 401k, you probably couldn't tell me. And so a lot of times people say, well, I can put, I'm doing the max. I'm doing 3%. That's not the max. That's the max that your employer is matching you. That's not the max amount of money. And so the max amount of money that you can put into a 401k as of 2021 is $19,500
a year.
A year. So think about that, and on the scale of, if we're talking about people who make $40,000, $50,000, $60,000, $70,000 a year, putting $19,500 into their 401k is probably not realistic, right? Because now you're talking about taking, let's just say 20 grand. If you make 40, you're talking about half
of my money.
And then you have to ask yourself this question: how many people are living off of half or 50% of their income, right? And we already visited that when we was talking about the spending plan, right? And so, you know, we have to be realistic. So there's going to be an issue, because if I want to retire at this age and I'm not putting enough money up, the reality is that I only have one option. I got to keep working, or I got to cut my expenses. We get back to the same thing. And so the question comes up is, how much money do I need to retire? I'm gonna give y'all this equation, and this is gonna help you out. Now, of course, it's not exact science, and you know the math is general, right? So you can't just say, oh, Marcus said this is the exact thing, right? But it's kind of give you a general idea of how much money you should have saved. And so basically, what you want to do is you want to take your desired retired income times 2 times 20 will give you your retirement saving goal. So I'm gonna say that again.
Yeah.
Take your desired retirement income.
Is that per month?
Per year. We're gonna do a year.
Per year. Okay.
Okay. Times 2.
Times 2.
Times 20. So let's put it. Let's give it in an example.
Yep.
So if I want to have $100,000 a year for the rest of my life, I would need $4 million of retirement savings. Because I took 100,000 times 2 times 20 equals $4 million. So I need to get as close to $4 million as I can in order to live off $100,000 for the rest of my life.
Gotcha.
My job is to help you figure out how to get this $4 million.
So is that 20 the life expectancy after?
It's basically just an equation that's going to try to account for inflation. And I know that on the back end of this is that we're going to take this $4 million and we're going to invest it into a vehicle that's going to be able to produce that $100,000.
Gotcha.
And so that's how this equation. Of course, I didn't make this equation up. This is just one that a lot of financial planners use in order to kind of get to that goal. Now, again, this is not exact, right? But if you can get as close as possible to that $4 million, I know on the back end that we can get you into a situation where we can get you at least around that $100,000 a year, right? Which translates to like $9,000, $8,000 a month, somewhere around there. You can take 100,000 divided by 12. You can get the number.
Yeah. So if I want $100K a year, times 2 times 20, I need $4 million saved in my retirement by the time I hit 60 or whatever retirement age.
Whatever retirement age, and it doesn't necessarily have to be all in your in your 401k. It can be in multiple vehicles, which is why I get to, if only thing you're doing is your 401k, that's where you're failing. You need to have multiple buckets, right? Because again, think about it like this. I'm gonna ask you this question. I want you to answer it for me. Do you think taxes are going up or down? Up, right? I don't care who you talk to. They're gonna all say the same thing. But we're putting all of our assets into a vehicle that is pre-tax, meaning I haven't paid any taxes on this money. But taxes are going up. So that means that all this money that I'm putting in this into this vehicle is pre-tax. I ain't paying no taxes on it. But then when I get ready to retire, when I need the money the most, now I got to pay taxes on this money. And that's the only vehicle I have. So that's why we want to talk to people about having multiple retirement vehicles or just multiple, investment accounts, whether it's a Roth, whether it's, the cash value insurance, the IUL, which I love a lot, right? Different vehicles that you can put your money in that's going to give you some tax-free. Because there's 3 places you can put your money: taxable, tax-free, and tax-deferred. Most people understand and are doing the tax-deferred because that's their 401k, 403b, 457, whichever one you have, right? But the one that's not getting funded properly is that tax-free bucket. So if I had to think about it from this standpoint, what do I want to put my money, right? Do I want to put my money in tax-free or tax-deferred? Think about it. Or taxable. If I could pick, I want to put my money, as much money as I can, in this tax-free bucket.
For sure.
Right? And so, you know, that's the areas that we help people to make sure that we're doing and diversifying. Because a lot of times people think they can only do one thing, but it's kind of counterintuitive when you think of it like if you go to the gym, you're not going to just go in there and work on chest, right? But that's what people think that about money. I'm going to just go in, I just want to do this, right? I'm going to work on my chest. Yeah, your chest is going to be diesel.
Them little legs.
Little legs, little arms, you know what I'm saying? Little everything,
Yeah.
right? And so we need to start training our brains to think of it. We can do multiple things with money, right? So I can save money for this, and I can also, you know, invest my money for this, right? And so that's kind of what I want to make sure that people understand.
So 401k, Social Security, and what was the third bucket? So the original breakdown of pension.
Yep.
And that's what your company is going to give you upon retirement, right?
Well, pension, they ain't giving pensions no more unless you get into a great situation where you get a pension. That's generally where how it was designed. I'm saying that, you know, most people in real life probably are going to have a 401k. I think Social Security is still going to be there. It's just going to look different. Right now, to what effect, who knows, right? But that's why we really shouldn't be depending on that. We can do some other things outside of Social Security to making sure that we're able to still live comfortably, and that's kind of what we help people with. And so, you know, the main thing is that if you're living off 100% of your income and you're not putting any of that back, you're gonna be setting yourself up for disaster. So if you're that person that's living off 100%, come see me. You need to see me.
Because you're going to have to maintain that forever.
That's my whole point, right? And then what happens if you get to a point where you can't work anymore? And that's the same thing I talk to people about in making sure that they have some type of form of paycheck insurance, right? So what happens if you go out here and you get injured and then you might say, hey, man, I got disability from my job. But what they don't realize is that they're probably going to only pay you 60% of your paycheck. Well, what about the other 40%? Are you living off of 60% of your paycheck right now? If not, we need to have a solution. We need to have a conversation about that. And so, you know, one of the things I'll say, man, is that when you talk about financial planning, it's not a do-it-yourself project. Like, this is not that, right? Google can help you, but it's not going to help you put this thing together, right? And then there's so much information out there, you got to figure out how to decipher it. And so by sitting with an advisor, they can kind of help, you know, get you through that noise. And so kind of get you on plan to make sure that in these areas happen, you know, that you'll be taken care of.
That's good stuff, man.
Yes, sir.
That's good stuff. I don't know if I can say this, and I'll cut it out if it's not public yet. But I did hear you on one call mention something called a super Roth.
Yes.
Yes. Have you already coined that?
Not yet.
Okay.
Not yet. But it's coming. And I just got to get through some compliance stuff to make sure that I'm good. So, but I love the idea of that. But basically what it is incorporating a product that already has a name, but I just call it a super Roth because it does some of the same features as a Roth, right? So you can't Google super Roth, right? You can't go in here and say, what is a super Roth? Because it's something I just made up. But basically what it is that you're buying an insurance policy. So I have to put that out there. You're going to buy an insurance policy. But the idea is that we're going to overfund this insurance policy, and the extra money is going to be going into an investment account. That investment is going to track, like an ETF, right, some type of index. And so for most people, it's probably going to be the S&P. And so the idea is that all of that extra money that's going to be in that the S&P bucket is going to just grow, and it's uncapped. So you can make it whatever the market does. And the great beauty about it is that you don't lose any. So you're not subject to stock market, real estate, or inflation risk. And so all of that money that you're putting into that bucket, you're able to take out tax-free, which is why I call it a super Roth, because it does the exact same thing as a Roth, except for now you get rid of, I can't touch the money before I'm 59 and a half, right? You get rid of, I can only contribute $6,000 a year, right? So you get rid of those two things, but you're still getting the same, performance, or not performance, but you're getting the same features as a Roth IRA. And so that's why I call it super. Plus, you're adding the insurance element too. So if something were to happen to you, your family would get compensated for whatever, the face amount of the policy that you had tax free.
Can you put some numbers on that really quick?
I could, but I would. It just depends because it's gonna be different, right, for everybody. So nobody's is gonna be the same because nobody's gonna have the same health, et cetera, because there are other factors that go to it. And so one of the main things that I tell people about this product, which is called an IUL, right? That's the technical name for it, which stands for Index Universal Life. And so the main thing is that you want to keep the cost of insurance down, right? Meaning that you don't want to have some super $1 million policy because then you got to overfund it. Because remember, that's what we're doing. We're overfunding, not overpaying, overfunding, right? So listen to the difference of the words. Overfunding, not overpaying, okay? And so the idea is that I want to keep that face amount as low as possible so that more money is going on into the investment side so that my cash value will start to build up, right? More versus paying more so for the insurance. If the need is for just insurance, this is not the right product for you. But if I'm trying to buy this as a way to put money and to grow it tax-free that I can use for retirement, home ownership, business, college. So what I've been doing here recently is I said, you know what, let's start putting these on kids, right? Number one, you're insuring their insurability. You get a $100,000 policy on them, right? And now you're doing $50 to $75 a month, which is nothing. And then when they get to college age, you got all this tax-free money that you can do whatever you want to with it. Take the money out at college and then continue to still pay for it. And then when the kid gets 24, 25, you turn it over to them, and then now they have a retirement vehicle that started for them.
So if the fund for that kid, let's use the kid for example.
Okay.
If the policy is a $100,000 policy and it costs me $20 a month, but I say I'm gonna put in $70 a month, that $50 is going to be invested
into whatever index we pick, which is why they call it an Index Universal Life, right? But most of the time I put people in either a Prism Fund or the S&P 500, which are really similar. And so whatever the S&P 500, that's what your money's gonna do. And so it's just gonna grow. And then what I tell people to do, you can start off with 50, right? Because the cost of insurance for a 2-year-old, 1-year-old is probably like $6 or $7, right? So you're putting 50. Just do $50 a month until they turn 5. And then up it, and because that's the beauty of it is it's a flexible premium, so I can change the amount that I'm putting in here yearly, right? And so now instead of doing a 529 plan, which you can still do that too, because remember, people think, if I do this, I can't do that. No, you can still do it. But the reason why I like this one a little bit better than a 529 plan or a UCMA or an UGMA which I still do those too. So for those people like, I got a UTMA or UGMA, okay, yeah, we do those as well. But the reason why I like it is because this money doesn't specifically have to go to college. Because the way the world is going now, what if your kid doesn't want to go to college? And if all the money is in this 529 plan, and that money has to go to school, and the only thing you can do is, without getting penalties and all that stuff, is either change the beneficiary or keep that money there. And so what if the kid doesn't go to school? Now you're gonna get hit with penalties, et cetera, right? And so we can get rid of that, do it in this bucket. Or you can do a combination of both, because maybe you got 2 kids, one of them go, one of them done. We don't know what our kids are going to do, right? And so
that's good.
It's planning, right? And so, and again, I want to make sure I emphasize this. You can do more than one thing, right? Am I saying the IUL is the best? No. I'm saying it is a complement or a supplement to other investments that you can do as well. So it's not like I'm saying, forget all that other stuff. This is the only thing I want you to do. And that's not what I'm saying. What I'm saying is this is a great foundation that you can build a lot of tax-free income, and we're talking about this generational wealth because we got the insurance side of it too. So if something happens to you before you get to a said point, now your family's gonna get not only the cash value but the death benefit as well. And I'm pretty sure that could do a lot to help advance your family's legacy.
And with that, I can pull that money out at any time?
So generally what happens is it's more like a 2 to 3 year period before you can start accessing that money.
Gotcha.
And so, about year 3 is probably when you can start pulling money out. But, it just depends. It varies, right? But I generally just say about 3 years. Now, technically, I would say don't touch the money for 10 years, right? That's what I would tell you. But, of course, people going to do what people do. Spend or spend. Right? So people see money in there that is doing
I gotta
this thing.
touch that.
You know what I'm saying? Real life story. I had one, a couple. They started in 2017, and it's doing really well, right? And they wanted to buy another rental property. So they just took the cash out, tax-free, to go put down payment on the rental property. Real life example. It works for their situation. So I was good with it because I knew where the money was going. So.
Gosh, we might have to have you back for another one. I feel like it's so much information, man.
Yeah.
But
no problem.
definitely appreciate that. Especially, I got a daughter. About to have another daughter.
Congratulations, brother.
Yep. So I'm always thinking about what those plans look like for them, positioning my family to win, you know, even in my absence. So I appreciate all of this information.
Absolutely, man. I just think that that's a great graduation gift. You know what I'm saying? Because it's going to be some real cash there.
True.
You know what I'm saying? And so, you know, I like it, you know. But again, everything that I said today is all general advice, right? If you want something specific to you before you make any decisions, make sure that you sit down with your advisor. And I must make sure that I say that.
Yeah.
Just because of all the licenses and stuff that I have, right? But make sure you do that. And the last thing I say, I always leave with what I call 6 steps to securing your money's future. It's
Talk to us.
So, step 1, make sure you have a clear idea of what you want your money to do. I think we've been talking about that all day. I need to understand where I want my money to go and what I need to do. I need to be telling my money where to go versus my money telling me what to do. And I feel like so many times people, they let their money dictate their positioning, right? But we can tell our money what to do, and that starts by changing our mindset. And how do we do that? Second step, automate your savings and hide from being stolen from you. I said that before, right? So we want to make sure that we get into some type of situation where that money is coming out of my account, you know, every month. I don't think about it. It's going, and it's not just in my double checking, but it's in an actual place where I can't have just access to it, right? We don't, no more double checkings, all right? We need to get rid of that.
I use Digit. Is that okay?
Whatever you want to use, Capital, Digit, okay. You know, whatever platform, Marcus Johnson, right? You know, at my firm, we can help you, Johnson Capital Planning. Third thing, diversify your investments and your income streams. I've hit that point too, right? You want to make sure that your investments are diversified, so asset class from real estate to stock market to business, and also your income streams, right? You can't just look at it as one. You need to have multiple ways to get money, period. We just live in that world now. Like, we've kind of moved away from, I'm just going to go to work and go home. You got extra hours in the day, figure out a way how to get some more money, right? And that'll help get these advanced financials out our communities, right? We need to get those away from our community, and we can do that because we are the culture. You know what I'm saying? And there's so much stuff that we can do to keep driving it forward, and we can figure out ways how to get money. And then as a culture as well, we got to just be ready to spend money with people who look like us as well. But I ain't going to get into that today. All right. The next thing is develop a long-term plan for retirement, right? And so that means that think about what age do you really want to retire, but make sure it's realistic, right? So if you are 30 years old and you haven't started yet and you say you want to retire at 50, I'm going to kick you out of my office, right? You got to be realistic. Now, unless you doing something, you know, maybe, right? But the reality is if we're making $50,000, $60,000 a year and we're talking about retiring at 50, and, you know, we just need to be realistic about that, right? And so that's kind of what we help you do. The next thing is buy life insurance to create wealth, right? The easiest way to transfer wealth without any taxes is buying insurance, right? So you can pay pennies on the dollar. So I can go out, and if every black man and woman got $1 million life insurance policy, I guarantee you they'll stop shooting us. And just let that sink in for a second, right? Because do you really want these Gen Zers with $1 million in their pockets? I'm gonna just let that sink in for a second, right? You know? And then the last thing is protect your main investment, and this is the most important one, is you, right? Make sure our mental is where we need to be. For me, I started to get into running, and I'm proud to say this, and I'm gonna just say it on air. I've lost 53 pounds since COVID started in March, and you know it's kind of changed my whole outlook. I got more energy, and so you know I'm really proud of that. And so you know protect that main investment, whether that's getting in the gym, whether that's going to get therapy. All of that stuff. And these 6 things will help secure that bag going into 2022.
That's good. That's good. All right. Well, I do this thing, man, where I blow this balloon up and then I allow my guests to write something on that balloon. That something is what fears, what obstacles do you see that people allow to handcuff them before they move forward with whatever it is that they desire to do? For you, you are passionate about music, you still do music. You're passionate about helping people secure their financial legacy, you figured out a way to do that. You ended up on Wall Street, But you said, hey, I need to go back and talk to my people and help them figure this thing out, and you started Johnson Capital. So what is it that you see that people have this vision, but there's something in between them and where they want to be, and that prevents them from taking any steps, period? So I'm gonna blow this up.
Okay.
And as I do that, I'll let you think, and then I'm gonna give you this marker, and we're gonna write on this balloon.
Okay. Just write it on anywhere?
Yep.
Okay.
Oh. Consistency. Talk to us. What do you mean?
I think that, I mean, that's with anything, man. We'll get this great idea. We'll even start talking about we're gonna put a plan together. But one thing that I feel like is lacking is just we're not consistent in it. We don't really build those habits to making sure that we're doing it daily, right? And so for me, I just use myself as an example. When I first started my journey to trying to get fit, I would go one day and then I wouldn't go no more. Or I go 1 week, I wouldn't go anymore. Same thing with when I started building this business, right? If I wouldn't have been consistent in my getting up and getting so many rejections, right? Because this is a tough business to survive in when you're dealing with people's money, especially when you're trying to do it with people of color. I was consistent every day with making sure that, man, I got these principles, these values, I'm gonna keep doing this regardless if somebody tells me no, right? I'm gonna just keep going in order to get said goal, right? And so for me, I got goals set for what I want the company to do individually. And so, I feel like if everybody starts to get a little bit more consistency in their life, everything will start to change for them. 60, 90 days will make a big difference into whatever your goal is if you're consistent in it.
That's good. That's good. Let's be consistent, man. So what we're gonna do is I'm gonna pop this balloon and we're gonna take the life out of the thing that stands in between people and what they want to do. All right, so tell people where they can find you, man. How can they be advised financially? Where can they find you on social media? All that good stuff.
Yeah, so you can reach me on website, johnsoncap.com, and you can send us an email at info@johnsoncap.com, or you can reach us on social media. My name, Marcus, Diontej, or you can go to our business page at Johnson Capital Planning, and we look forward to working with you, figuring out what your goals are, and helping you to secure a legacy for your family.
Good stuff. I appreciate it, bro.
I appreciate you for having me.
Yep.